Looking pretty good this Wednesday morning. Good morning, good morning. From New York City, equity futures higher by 0.9%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, President Biden says the banking crisis is calming down. It's day 2 for financial regulators up on Capitol Hill. And over at UBS, Hammers is out, Ermotti is back in. We begin with the big issue, more questions than answers.
We're left with many questions.
I got a lot of questions.
The Fed had plenty of authority to prevent Silicon Valley Bank.
It looks to me like the regulators knew the problem, but nobody dropped the hammer.
What I worry about is the fundamental unfairness here.
You're asking important questions.
I also think you raise important questions.
If you had stress tested Silicon Valley Bank, it wouldn't have made any difference, would it?
I don't know the answer to that question.
You stress tested for the wrong thing.
These decisions were made before I arrived, but I agree with you that.
But it's like somebody going in for a test for COVID and getting a test for cholera.
The bank executives lost their jobs, as should some of these regulators. Shouldn't that be the case if they're asleep at the wheel?
I want to be very careful. There are laws and procedure. I don't have a definitive answer for you at this moment.
The team coverage begins right now with Bloomberg's Anne-Marie Hordern down on Capitol Hill, Katanga Johnson in Washington. Katanga, first to you. We've had day 1. What are you looking for from day 2?
Today, we really do expect lawmakers in the House to really drill down on 2 main themes. On the one hand, lawmakers will be curious about whether the FDIC acted quickly enough in the process of trying to find a bidder for Silicon Valley Bank, as well as focusing on the Fed's role in really using all of their authorities to prevent this issue, and whether the agency knew soon enough sort of how bad things were at Silicon Valley.
AMH, you saw what the president had to say about the current crisis. I think we've done what we need to do executively. I feel confident that things are settling out. The markets seem to be responding. I'm not sure whether we'll get much legislative change. On the policy front, Anne-Marie, just where are we now?
Well, Jonathan, what we hear from lawmakers that they want all the details first and foremost. And when it comes to policy, it's going to be very difficult for a divided Congress to change really any policy unless it's the FDIC limit. This really seems to be the one issue on Capitol Hill that lawmakers, either Republican or Democrat, are actually looking into. Do you need to raise this insurance cap? But if you're looking at regulation, what the Biden administration would like to maybe see a rollback of 2018 of Dodd-Frank that many lawmakers, the most likely you'd think of Senator Elizabeth Warren, who yesterday asked all the officials in the room and the regulators in the room, should there be more regulation? They all said yes. That kind of legislation, Jonathan, that is not going to happen on Capitol Hill, not in this Congress.
And not the only development in the last 24 hours. Also, Anne-Marie, this morning from the Senate Finance Committee chairman on Credit Suisse. AMH, this quote from them is brutal. At the center of this investigation are greedy Swiss bankers and catnapping government regulators. And the result appears to be a massive ongoing conspiracy to help ultra-wealthy U.S. citizens to evade taxes and rip off their fellow Americans. What do you make of the language, the allegations that came from that individual and the committee chairman earlier on?
Yeah, Senator Wyden this morning when that report came out, Jonathan, this really blistering attack of Credit Suisse, which obviously you know better than anyone else, has had their own issues, and they've now been dissolved within UBS. This is a moment, really, and you're going to see a lot of attacks against banks in general going into the 2024 election. They're pointing the finger that some of these banks are helping wealthy Americans not pay their taxes. And remember, it's Democrats that really wanted to put money into the IRS so they could go after what they would call tax cheats.
AMH, Katanga, to the both of you, wonderful as always, the team coverage down on the ground on Capitol Hill. Day 2, day 1 was in front of the Senate, day 2 is in front of the House. I want to start with this quote. It comes from Neil Dutter of Renaissance Macro. Pick your battles with the consensus wisely. There is no middle ground in a banking crisis. It either happens or it doesn't. This means the bond market is either pricing in too many rate cuts or not enough. Priya Misra, Samir Samana, join us right now. Priya Misra, I want to come to you on that. Neil Dutter's language. The bond market is either pricing in too many rate cuts or not enough. Priya, which one is it?
I think the market is actually pricing in both, right? The market has to price in weighted average probability of outcomes. I do struggle with the average pricing here because the market's saying the first 25 basis point rate cut happens in September, but then the Fed only cuts 175 basis points. I think if we're looking at a hard landing, we're in the hard landing camp. The Fed's going to cut much more than that 200 basis point that's priced in. But our view is that the Fed starts those cuts much later. So they start later this year and then they cut a lot more. But I think the market's pricing in, I would call it a sort of bimodal distribution. There's a view that this blows over and there's no lasting impact of the bank crisis. And so the Fed gets rates to 5% and then very slowly, according to the dot plot, cuts rates to 3%, over the next couple of years. And then there's this view that there's going to be a hard landing. There's much more to come here. And therefore, the Fed will have to cut more. I think we don't know. There's high uncertainty. That's why the bond market's moving 25, 30 basis points every day. The market's pricing in this weighted average probability. And those probabilities change, every day or multiple times a day. So we are pricing in sort of both these outcomes.
Samir, what's your take on this?
Yeah, I mean, look, the market's just pricing in too many cuts. I mean, again, not to take anything away from what's happening, but I think to I guess maybe define it as a banking crisis is maybe the wrong way to look at it. I think probably the right way to look at it is a lot of people got caught on the wrong side of long duration, and that's really what's going on here, right? When you look at a lot of non-earning growth companies last year, which happen to be the clients of a lot of these banks, which happen to want their money all at the same time, I mean, I think you have to look at it through that lens. They also happen to have too many securities that were long duration on their balance sheets, so that didn't help. And I think, this is probably the start of kind of the recognition that much of this year will be spent in kind of this rolling credit crunch, and a lot of this can be kind of tracked back to the Fed is raising interest rates. And for the longest time, a lot of people looked past that, almost dismissive of those rate hikes. And I think what we would remind people is, look, it's been only about a year since the Fed started raising rates, and this is kind of when those long and variable lags start to kick in. So in our minds, this is kind of the start of the process, but it also shouldn't lead to rate cuts later this year.
One feature of this conversation on this program over the last couple of weeks is the idea of data dependency, Priya. And I've asked it a few times, dependent on what data. This is what the calendar looks like now. Payrolls on the 7th of April. On the 12th, we get CPI. I hear nobody talking about those two data points. I hear them talking about banks, earnings from First Republic on the 13th, JP Morgan on the 14th. I hear them talking about the Senior Loan Officer Opinion Survey as well. Priya, what is the data, the incoming information that's going to reshape this rate story at the Federal Reserve?
Sure. So I think, every data is important, but I would say the data you talked about, whether it's payrolls or CPI, it's going to be a lot less important because it's picking up credit conditions 6 months prior. It's actually even picking up monetary policy, I would argue, 6 to 9 months earlier. So the data we'll be watching will be, what happens. I still think of this banking crisis as a liquidity crisis morphing into a capital crisis. What happens on the liquidity front? Are banks having to rely on either home loan or the Fed facilities, in which case this becomes more of a capital crunch. And then ultimately lending standards worsen. Is that going to impact loan growth, going forward? How do financial conditions evolve? We'll be looking at still, I think, bank economic data, if you may, or the data around the banking system, I think will be far more important because I don't think that we can, go back to where we were 3 weeks ago. I mean, whether you talk about regulation, you were just talking about that, whether that comes out of this or the banks themselves become more risk averse. I think we'll be watching banks because the data right now is not reflecting the banking crisis. I think it's going to be at least a few months before the data starts to reflect this. The Fed's supposed to be forward looking, and we know markets are certainly forward looking. So I think we'll be watching the banks much more than actual economic data.
So in the near term, May 3rd is the next meeting at the Federal Reserve. Samir, do you think they will have is it reasonable to expect them to have sufficient information to make a rate call by then?
Yeah, I mean, look, going back to the previous question about, what are they going to be looking at? I think it's going to be a combination of both kind of inflation and unemployment and also, kind of what's going on with credit conditions. I mean, at the end of the day, as much as we would like for the Fed's mandate to be leading credit, it's really unemployment and it's inflation, right? Two of the most lagging variables. That is their mandate, whether we like it or not. And so if inflation starts to tick back up, if wages start to tick back up, if the labor market remains incredibly strong, does the Fed say, we're going to kind of pause here just to kind of see how things play out? I think that's pretty unlikely. They have to kind of withhold, kind of the line on kind of their mandate, because, look, if you give these markets time, they will heal, and pretty soon we'll have inflation kind of rearing back up. I mean, look at what's happening with oil and the energy markets.
Samir, stick with us alongside Priya Misra as well. Your equity market up 0.9% on the S&P. We'll continue that conversation. Mike McKee's going to join us in a moment as well. I want to get you some movers. Here's Katie Greifeld. Hey, Katie.
Hey, John. Well, let's start with the big news out of Europe, and let's start with UBS. Sergio Ermotti, he's going to be back in the saddle as UBS CEO. He's going to take over on April 5th to oversee the Credit Suisse acquisition. Ermotti, obviously well acquainted with UBS and Swiss banking, given that he spent 9 years in the CEO's seat. You can see that UBS shares higher by about 3.5% at this moment. And sticking with CEO shakeups, Macy's also came out this morning and announced that CEO Tony Gannett will retire in February 2024 and hand the reins over to Tony Spring. He is the current CEO of Bloomingdale's. Macy's down a little bit on the news, just 0.5%. And on the earnings front, we had two big names report after the bell last night. Lululemon up 16% pre-market after issuing a beat and raise report. Adjusted EPS beat estimates, annual sales outlook surpassed expectation. And Micron also rallying pre-market. John, there was a lot of concern about the demand picture for memory chips, but the sales outlook suggests that maybe the worst is over.
Katie, thanks for that. We'll catch up with you around the opening bow. Coming up, a banking issues a substitute for rate hikes.
This was ripple number one, and we don't know what it's going to cause. We know the government can help us backstop the deposit base, but we don't know what ripple number two is. I don't think the Fed sees them having a policy conflict, but the market certainly does.
That conversation up next.
The risk has gone higher, for sure. They don't know what the impact of all this hiking and the banking liquidity squeeze is really done. And the truth is, I don't think it's increased the risk of inflation, right? It slowed down the economy. It will slow down lending. It will slow down inflation. Does that mean if the inflation is dead? We're not going to know for a long time. But the risk of disinflation and the risk of a bust is definitely higher.
A whole host of Fed speakers returning to the spotlight after a heated few weeks on Capitol Hill. Markin, Collins, Kashkari, Williams, Cook and Waller all on deck this week, facing a market with nearly 100 basis points of rate cuts already priced in by year end. The argument's simple. The banking crisis will do most of the work for them. The St. Louis Fed President Jim Bullard weighed in on some of this. He said continued appropriate macroprudential policy can contain financial stress in the current environment, while appropriate monetary policy can continue to put downward pressure on inflation. Mike McKee joins us right now. And Mike McKee, I guess the question is whether you can deal with both these issues separately.
Yeah, that is the question going forward, and it'll be interesting to hear from the rest of the Fed officials. Right now, it looks like they are dealing with inflation. You take a look at what's been happening in the economy. It has been slowing. The Red Book retail sales numbers that come across on a weekly basis show a decline in year-over-year activity at the same time that PCE inflation is going down. Now, we'll catch up with the PCE. These are February numbers on Friday when we get the latest update. But as Priya said earlier on the show, these are backward-looking data. So what are we going to look at more forward-looking? We can't get anything that's actually going to tell us the future. But the most immediate things in the background are things like this, the St. Louis Financial Stress Index, which does show the greatest amount of stress in the financial sector over the past couple of weeks since the pandemic and before that, the great financial crisis. Now, these numbers only go through the 15th. So we'll be waiting today at the end of the day to get an update on whether financial stress has come down or not. And then you have the question of what's happening with banks. And as Neil Dunham was saying, and you quoted him, it's either a bank crisis or it's not. Right now, so far, it's not. We're looking at lending there from all banks and from small banks. And as you can see, not only have they held up, but last week they rose. So we'll see if that continues this week when we get the data on that at about 4:15 on Friday. We'll see what's happening with the banks, and we will see if we are having a crisis or not. So the Fed speak is going to have to depend on reading the tea leaves of these more coincident indicators than on looking backwards at things like PCE on Friday, as important as that'll be to traders.
Mike, you and I have talked a lot about whether policy is truly in conflict. I think a lot of people have written about that over the last couple of weeks. Seth Carpenter at Morgan Stanley totally disagrees. Mike, you wrote this over the weekend. Central banks are deliberately tightening financial conditions in order to slow their respective economies and thereby bring inflation down. What the bank's disruption does, however, is make it harder to calibrate the correct degree of tightening. So, Mike, it's not that policy is in conflict per se. It just makes the calibration of policy more difficult. Do you have sympathy with that view?
Absolutely. And that is something that Jay Powell talked about in his news conference, and the Fed officials have been talking about since, that they know that bank lending may tighten because of the bank issues, but they don't know by how much. And the estimates from Wall Street firms are all over the lot, from 0.3% to 1.5%. So at this point, they kind of have to watch and see. And that's why it's going to be a game time decision for them next time on rates, because they aren't going to have a really clear picture of how much tightening there's going to be of credit and how that's going to affect lending.
Not by early May, not based on what we've seen so far. Mike, thanks for that. Mike McKee, thank you. Priya Misra, I wanted to come to you on that. I'll read that quote again from Seth Carpenter at Morgan Stanley. Central banks are deliberately tightening financial conditions in order to slow their respective economies and bring inflation down. What the bank's disruption does, however, is make it harder to calibrate the correct degree of tightening. Now, just 3 weeks ago, Priya, we were talking about no landing, maybe opening the door to 50 basis points, maybe having a look at 6% on Fed funds. Just 3 weeks ago. Now, Priya, who is to say we won't be back at that point in another 2-3 weeks' time if this banking crisis fades?
So I think it's interesting. You say fade. So maybe some of the financial stress issues, the liquidity crisis, the bank runs, that can stop. Will the capital issues that the U.S. banking system faced, does that go away? And I would argue it doesn't. I think you've opened a Pandora's box. There are massive unrealized losses sitting on bank balance sheets. If banks are having to pay up for deposits, that net interest margin is going to be under pressure. So I think we have to recognize that the banking system is going to have to delever. Either they're going to have to shed assets or raise capital or some combination of both. And that's going to impact lending standards. You know, I think it is going to have an impact on the economy. But when and where does it show up? I don't think it shows up in the labor market, may not show up in inflation for a while. So I think what we have to get used to will be a Fed that's going to sound a little tone deaf, because they're going to look at their dual mandate. They're going to potentially hike in May. They might pause, but I think to justify these rate cuts, you have to see the tightening in lending standards show up in the data. And I think the Fed is in a very different position now than they were during COVID or during 2008, where they had the luxury to be preemptive. They don't have that luxury. So, you know, I think things can absolutely fade. The sentiment in the market can improve. But if lending standards tighten at the same time as that savings buffer, the consumer savings buffer that we've talked about so many times, that has provided that cushion to the consumer, that savings buffer is running down. This is exactly when the banks should be making loans. And if the banks are actually stepping back, I think it adds to the monetary tightening. So I think the market is doing a lot of that work for the Fed. But the Fed is looking at data that is not going to show that. So I think they can pause. They can absolutely pause after 1 or 2 more hikes. But I think then the market will have to get used to a Fed that's not being responsive enough. And that's why I think owning the front end to me looks risky, because it's a view on, you know, when does the Fed start to cut? Own the long end, because this is absolutely going to result in a hard landing. It's just when that happens and when can the Fed respond. I think that is extremely difficult to sort of, you know, calibrate, to use Seth's words.
You mentioned that word when a few times, so let's talk about the when. Andrew Hollenhorst of Citi addressed some of this. His view, we do not think that the disinflationary or deflationary impact from slowing lending and weaker growth would come into effect until 2024. Samir, when you think about the when of this, you think in 2024?
I mean, look, we think there's a moderate recession in the very back part of this year, and inflation probably doesn't meaningfully come down to the Fed's, you know, kind of 2% target probably until next year, you know, setting the rate, you know, the stage for rate cuts, you know, again, probably early part of next year. What's really interesting is, so the same market that's pricing in rate cuts now has 1-year inflation break-evens at 3. So, you know, kind of riddle me this, Batman, right?
Yeah.
I mean, how can you have 3% inflation a year from now with the Fed cutting rates aggressively in the back part of this year? It's just not going to happen. So either one of the two things needs to be reconciled. Either you can have a very tough recession in the latter part of this year, which gets inflation down to 2% and the Fed cuts, or inflation still is kind of middling in that 2, 3, 4% at the end of the year, and the Fed is still at 5%. I think we're probably in the latter camp. We think markets are range bound, with probably a little bit of a skew to the downside. But, that's going to be the real exercise for investors this year, is they're going to want to try to push things both to the up and the downside. And what's really going to happen is we're probably not going to make a lot of headway between now and year end.
So, Samir, those 2 points, okay? Option number one was disinflationary bust. Option number two was inflation stays too high and the Fed stays at 5%. Now, you're leaning towards the latter, Samir. Talk to me about the capital allocation decisions you'd make with that in mind.
So you play defense. We're playing defense on the fixed income side, and we're playing defense on the equity side. So overall, we've got a little bit of money from equities into fixed income, but then within stocks, we like large, we like mid, we don't like EM, we don't like smalls, we don't like developed. On the sector side, we like energy, healthcare, tech. We think all of those have some durable demand for their products and services. We don't like consumer discretionary. We don't like real estate. We think both of those are weak points in the economy. And then on the fixed income side, we like a barbell. We like the short and the long end parts of the curve, and we would continue to fade credit until we get paid to take that risk.
But Samir, you like US, right? US over rest of the world, even though that the epicenter of risk right now is right here?
Yeah, I mean, look, if you look at the S&P, it's almost 65% growth areas like healthcare, like technology, like consumer discretionary, at least, kind of the more growth-oriented parts, the comm services parts. If you look at financials, really you don't even get to a bank in the top, holding, right? It's really kind of a financial conglomerate. So I think you've got to look at kind of composition. It really matters in this kind of market.
Samir, smart, as always. Samir Samana there, Priya Misra, to the both of you. Brilliant. Thank you. Thank you very much. Equities right now at 1%. Just a range of views. You take your pick. I'm not here to make a judgment. Coming up, the morning calls, and later, the case for energy stocks. Why Alpine's Sarah Hunt sees opportunity in recent weakness. That conversation happening around the opening bell. About 7 minutes away. Said this a few times already this morning. In that kind of market where no news is good news and no news on a banking crisis, I guess, is good news. Equities up by more than 1% on the S&P. On the Nasdaq, similar move. On the Russell, similar move, with that heavy weighting on the Russell towards the financials. That's the price action. Let's get you some morning calls. First up, Morgan Stanley downgrading Sienna to equal weight, seeing limited expansion this year due to weaker demand. That stock's down 2%. Gordon Haskett downgrading Macy's to a hold, saying recent data revealed softening trends in foot traffic and digital visits. That stock down by only 0.6%. And finally, Susquehanna upgrading Carnival Cruise to positive, expecting a strong travel season this summer after earnings topped estimates. That stock up by 2.9%. Coming up next, Alpine's Sarah Hunt seeing opportunities in beaten down energy stocks. That conversation around the opening bell. 23 seconds away from the opening bow this morning. Good morning. Equities doing okay, up by 1% on the S&P. On the Nasdaq, up by 1.2%. Will it stick? And can the S&P 500 break away from 4K in a big way? Over the last few months, going back to November, just in and around 4,000. 5% up, 5% down, but can't get away from it. Let's your opening bow, switch on the board and get to the bond market. Yields look like this, higher by 2 basis points. Let's call it 360 on a 10-year, 359.43. In the FX market, euro dollar 108.36, negative 0.1%, and crude back nicely in the 70s over the last week or so, up 1%, 73.99 on WTI, just short of 74. About 20 seconds into the session, your equity market shaping up as follows. A lift up 0.9% on the S&P. We had some weight back into the Nasdaq, up more than 1% on the Nasdaq right now. What stock to watch at the open? Micron. Shares moving higher after issuing a better than expected outlook. The CEO saying this: customer inventories are getting better, and we expect gradual improvements to the industry's supply-demand balance. Ed Ludlow on a story. Morning, Ed.
Yeah, good morning, Jonathan. That statement and also the forecast for the fiscal third quarter of sales at $3.9 billion above street expectations is being taken by the market and a number of sell-side analysts to mean that the down cycle we have seen in memory-related chips may be nearing a bottom. bottom. Remember, Micron does not have a very diversified business. It's the biggest maker in the US of memory chips, but it competes with Samsung, SK Hynix, in an industry that has really seen its end market slow down. We're talking smartphone handsets. They do have some offerings when it comes to data centers. That market for data center memory bottomed in the fiscal second quarter, the quarter just gone, according to Micron. This terminal chart, though, is critically important. It tells the story. The loss that's expected in 2023 is the widest, the biggest deficit for Micron, going all the way back to 1984 when they first went public. The story of the last 12 months is that this has returned to a cyclical industry, boom and bust. There has been bust when it comes to memory chip. What we're seeing is that actually, instead of making new orders, smartphone companies and other device makers have been working through their inventories and backlog. That's what we're talking about here from the CEO. That situation's improving, and I think what we see is the upcycle potentially starting in the second half of this year. We're trailing the Philadelphia Semiconductor Index on a 12-month basis and also a year-to-date basis, but looking on the gains at Micron, we're now up more than 4%, closing that gap in performance terms.
A nice move there this morning. Ed, thanks for that. Bigger move here. Lululemon absolutely flying, overcoming its own inventory issues and delivering an upbeat forecast. The CFO had this to say: looking ahead, we remain optimistic regarding our ability to deliver sustained growth and long-term value for our stakeholders. Katie, that stock up more than 12%.
Absolutely surging, and all of that is just a fancy way to say that leggings are in high demand right now. Athleisure, super hot. That's what we heard from Lululemon last night. And that gain that you're looking at, 13% as the bell rings, that is the biggest gain in 3 years if it holds. And that all comes down to the outlook that this company delivered last night. The headline figures topped estimate. Lululemon sees revenue at $9.36 billion. Analysts had been looking for $9.1 billion. Adjusted EPS guidance also beat. It's seen at $11.61. That's about 32 cents higher than the estimates. Sales growth, meanwhile, that measure is actually seen slowing. Sales are expected to rise about 12% in fiscal 24, 14% in fiscal 25. That's still double-digit growth, though, John, and shareholders seem to like it.
I don't like that Midtown uniform, you know, that the guys are wearing with the Lululemon pants. Do you know that one?
I'm well acquainted with it. I got to say, it's all about the range of motion.
Yeah, not a fan. Not a fan. Katie, thank you for that, as always. The stock's flying. It's doing nicely, up by 14%. Close here could be one of the biggest day of gains we see for that name, going back to spring 2020, and that's when fashion just collapsed. You remember. The team at Jefferies throwing some cold water on the retailers, saying this: maintaining their underperform rating, better 4Q and better outlook, but our concerns haven't gone away. We remain guarded as competition rises and the consumer environment slows further. That's the latest from them on that name. Elsewhere, UBS have this to say: Hammers is out, Amati back in.
I'm fully aware that we need to work very hard here to avoid any consequences for the taxpayers in Switzerland. So I think you have my word and commitment that I, together with my team, we will work and do everything that it takes to make this transaction successful.
Marion Hoftemeier joins us now from Zurich. Marion, big news, Amati's back.
Definitely. So it's a ghost from the past for UBS. You know, he was the former CEO of UBS and led really that bank to a stability, to the behemoth that it is today and the stable bank that it is today post the financial crisis. And now they've said, you know what, he's the best horse we have in the book to help us through this transition of really taking in Credit Suisse and sorting through this very complicated integration that will take a number of years to complete.
He might have to deal with some Credit Suisse regulatory issues as well, maybe even some fines. Marion, I was just wondering what your thoughts were on that statement that came from the Senate Finance Committee Chairman, Ron Wyden, a little bit early this morning, and I can share the quote with you. At the centre of this investigation, greedy Swiss bankers and catnapping government regulators, and the result appears to be massively ongoing conspiracy to help ultra-wealthy US citizens to evade taxes and rip off their fellow Americans. What's Switzerland make of that comment this morning?
This isn't an entirely new comment, right? I mean, Switzerland has had to deal with the tax evasion issue for a long time, and there were a lot of settlements back in 2014, 2015 with Swiss private banks. So, you know, it's unfortunate timing for this acquisition, and it will be something that UBS will have to deal with both from its own perspective if it's involved, but also from Credit Suisse's perspective, and the landscape itself is now being questioned. Okay, you know, are they doing things they shouldn't be doing?
Marion Hoftemeier, thank you, on the latest over at UBS. And this is exactly why UBS, I imagine, pushed for that government guarantee a couple of weekends ago, just in case there was a big fine coming because you inherit problems from the likes of Credit Suisse. We mentioned this a few times over the last couple of weeks. Clearly, the regulators and officials have learned their lessons from 2008 and the financial crisis based on the actions we've seen over the last couple of weekends. We've also said clearly the banks have learned their lessons as well, based on what happened with some banks. I'm thinking of JP Morgan, helping out others in the financial system, and then inheriting their legal issues on top of all of that, which is why perhaps UBS pushed for that financial guarantee. Sarah Hunt of Alpine Saxon Wood seeing opportunities elsewhere in energy. Energy stocks have been weak due to lower commodity prices and fears of recession. We think there is an opportunity there. Sarah joins us right now. Sarah, if people think we're facing a disinflationary bust, why do I want to be in energy?
I don't think that you need to rush into energy. I think that you have time, but I also think that there's a bit of complacency going on now that we've had a warm winter in Europe, and we've seen, the question of what's going to happen with China, whether or not we're going to get a recession in the U.S. That's all been weighing on commodity prices. But I think that you will have some issues as we get into the summer, if we have a very hot summer, because there is a weather component to energy. But I also think that you've got, as I've said earlier, years of underinvestment in energy and traditional energy. And I think that there are both interesting opportunities on the more traditional energy side, like a Devon, and I also think that something like a Chart Industries that plays into LNG is also a very interesting situation where it sits right now.
Sarah, do you think we are facing a disinflationary bust? Is that your underlying assumption here?
I think there's so much right now that depends on what happens with the economy. And there are so many, that's such a wide sort of probability curve right now, because it's really hard to figure out, are we completely done with this banking crisis? If so, that would be an unusual, very short version of what could go wrong when you have a massive change in interest rates. Do we have a slowdown economically across the world? Does the U.S. slow down? Does China come out of this faster? I think the U.S. is still experiencing a lot of economic prosperity on the back of 2 years of sitting at home and not doing anything. So I think that there is a very uneven recovery in this economy. So it's very difficult to parse out exactly how this goes forward. I think it's difficult, however, not to assume that some of this credit tightening that's going to come about because of the banking issues is not going to slow the economy. The question is, how slow does it get?
So, Sarah, the other question then is, where do I want to take cyclical risk? Some people are just going into tech. Lower rates, a rate cut away from another tech boom. We've all heard the same thing, Sarah. Are we underestimating the cyclicality in that sector?
I think that you had such an overreaction to higher interest rates in some of the larger tech stocks where there still is going to be growth that didn't really need to have lower interest rates in the way that people sort of expected. So I'm not sure where that goes, but I definitely think that there's growth in the tech sector. So you're going to see people going back in there, as you've already seen. I mean, the best performance so far this year has not been in the cyclical sectors or the economically sensitive sectors. It's really been in the tech sector. Even as interest rates started to go higher, there was sort of a snapback from last year because those stocks were down so much. And I think that it's more likely that the Fed pauses than turns into an abrupt cycle of cutting rates unless there's much more stress in the economy. So I don't think that we want to see the Fed cutting rates, because I don't think we want to see the stress in the economy that would force that.
This is something Wei Li of BlackRock said as well, Sarah. I'd love your response to that. Just a number of weeks ago, I'm not talking months, years, I'm talking about a couple of weeks ago, there was still this belief that the Fed put was gone, that the regime had changed. Wei Li of BlackRock said this: we don't see rate cuts this year. That's the old playbook when central banks would rush to rescue the economy as recession hit. Do you take that side of things? Does that resonate with you?
Well, I think if you just look at what happened in the last couple of weeks with the banking crisis that we had in March, the ECB hiked rates 50 basis points. The Fed did not pause completely. There was some thought about hiking 50 basis points before we got through that banking crisis. But the fact that they raised 25 basis points also says that they are really worried about inflation. And I think the historical playbook in the last decade has been, there's no inflation to worry about, so we can do whatever we need to with rates to make sure that we stimulate that economy. We're in a much different situation now, and the tensions are much stronger between, I want to cut rates because I see things, going apart in the financial world, versus I've got this inflation issue on the other hand. I think it's going to be very difficult. And I think you're also starting to see the slowdown that's coming from high rates in things like auto loan, people being accepted for auto loans and things along those lines. I think that is just starting to happen. And so it's not so easy to turn around and cut rates here with the backdrop the way it is.
Sarah, I want to finish on the market at the index level. The S&P at 1%, just north of 4K. Sarah, you can take that chart back to November. this index on the S&P 500, one way or the other, has struggled to get away from 4,000, Sarah. What is it about this level?
I mean, you could talk about the psychological level of round numbers, right? 4,000 is a flat number, and it didn't go to, it's been stuck in a range. But I think that just talks about the uncertainty that we have right now, both on the economic side and on the financial side. First, you had, rates going higher and people were piling money into bonds and treasury bonds. And then the incredible drop of treasury bonds, like look at the 2-year that went from 5% to 3.5% in basically 5 days. I think that also sort of pulls money, put money back into things like money market funds as people wait for the stock market to go higher. I think that we're just experiencing some real uncertainty on both the financial level, the economic level, and I think that is translating into a market that really is kind of stuck in between. Are things going to get better or are things going to get worse? And I don't think we know the outcome to that right now.
Sarah, the range on this 2-year this month, unreal. Sarah Hunt of Alpine, thank you. As always, the range on this 2-year this month, 5.08% intraday high, 5.08, 355 intraday low. And a couple of weeks separate the intraday high and the intraday low of 5.08% and 355. All at the front end. Right now, let's call it 4.1% on the 2-year. Coming up, the debt ceiling fight heats up in Washington.
I don't know what we're going to meet on. The deal was we each put down our budget.
That conversation up next.
MAGA House Republicans want to add over $3 trillion to the debt. They've even suggested they won't release a budget so they can hide how much of their deep and harmful program cuts are just paying for their tax cuts.
President Biden and Speaker McCarthy locked in a duel over the debt ceiling. McCarthy sending a letter to the president demanding they begin negotiations on spending cuts and regulatory changes. Biden pushing back with a letter of his own, challenging Republicans to produce a public budget plan first. AMH down in D.C. Anne-Marie, lots of noise, little change.
Yeah, John, what you're seeing right now is that these two parties are really just digging their heels in for this standoff. And it comes as we were just getting ever so close to reaching that debt ceiling, the X date. Secretary Yellen had said, look out for June. A lot of people are talking about July or August. But the fact of the matter is you have these dueling letters. And what the president responded to Speaker McCarthy, who, by the way, the speaker told the president he needs to start rolling up his sleeves and getting to work in a discussion, is that the Republicans need to put a public budget plan first so that all of Americans see what they want to do. And he wants them to do before they leave for a 2-week recess for Easter. The president, though, didn't say he would not meet Speaker McCarthy. And besides the letter, when he was boarding Air Force One yesterday, he told reporters, I just don't see the point of sitting down with them yet. What is there to discuss? So the White House is once again putting it back in the House GOP hands.
So, AMH, in the meantime, we're all talking about the same thing, which is the X date. I speak to people on Wall Street, as you know. They're not taking this seriously until we get close to that. I'll ask them a question. They'll give me the same response. Where is that X date?
Yeah, we don't know the precise X date, but everyone's talking about the summer where this could really come to a brink. And I think now this is why the financial markets aren't freaking out just yet. But when they do, potentially it's the financial markets that are going to be the ones to push Republicans and Democrats to get on the same page and make sure that they can raise the debt limit. Jonathan, when you talk to a lot of people, they talk about 2011. They had the votes, and yet still the U.S. was downgraded. And that's because the financial markets took notice and there was a bit of panic.
So you're on Capitol Hill today. We had day one of the hearings yesterday. We've got day two in front of the House today. Anne-Marie, I noticed two distinct arguments. And maybe it's a bit of both at the same time for some people. But one, do we need more regulation? People think we do, of the banks. And two, did we just have a lack of enforcement of existing regulation, given what they knew when they knew it, and didn't do anything about it?
Yeah, these are 2 points that you're likely going to hear brought up again today. When it comes to new regulation, this is something that Democrats really want to push. You also heard from Michael Barr, the Fed Vice Chair of Supervision, saying that they may themselves boost the capital liquidity requirements for banks worth about $100 billion or so. But then when it comes to what did they know and potentially just not executed on, this is where Senator Tester really made a point. He said, it sounds like you knew there was a problem, but no one brought the hammer down. And Michael Barr said that there was warnings there about SVB, the fact that they didn't hedge against their short-term paper in this higher interest rate environment. So you're going to hear a lot of that, Jonathan, today, but you're also going to hear a lot of partisan voices as well. Today, expect Republicans to go after quote-unquote woke banks, that they were too focused on ESG. And for Democrats, it's really going to be about the fact that there's this loosening of regulation, and they want to see more regulation put on these mid-sized banks.
The guy we're not talking about is the Fed chair, Jay Powell. And at what point the Board of Governors knew about all of this stuff, Anne-Marie? When did it hit his desk? Did we get much clarity on that yesterday?
Yeah, not much. We do know that Michael Barr was really brought to the surface of all of these problems in February, so potentially that is when, as well, Fed Chair Jay Powell also was aware. When it comes to the Fed Chair, Jonathan, we should note that Barr was pretty honest yesterday and also saying that they would be a little bit more welcoming and open, as the Fed Chair said as well, to an outside investigation. This is something that a number of lawmakers have called. Why should the Fed be investigating themselves? Potentially we need to bring in an outside probe.
MH, great work as always. Looking forward to day 2 of the coverage and you leading it. Anne-Marie will lead the coverage through the day and then again at 5 p.m. Eastern time. Balance of power with Joe Matthew. Looking forward to that. Speaker McCarthy then, bit of tension between him and the president, bit of tension between him and Beijing as well. Bloomberg learning the White House National Security Advisor spoke with China's top diplomat just last week. The country now warning Taiwan's president against meeting with Speaker McCarthy during her trip to America, writing this: if she meets with McCarthy, it will be another provocation that severely violates the One China principle. We resolutely oppose this and will definitely take measures to respond. Emily Wilkins joins us now for more. Morning, Emily.
Good morning, Jonathan. Well, certainly some very interesting developments going on, both with National Security Advisor Jake Sullivan speaking with China's top diplomat. Clearly an effort here by the Biden administration to start bringing the temperature down again on the relationship between the two countries after tensions really got raised with some of those balloons that were floating overhead. And so this is the Biden administration's attempt to really get things back on track, to potentially set up a call between Biden and Chinese President Xi Jinping, and to sort of reestablish some of those connections between the two countries. Of course, right as this is happening, you have Taiwan's president coming on a 10-day trip to the U.S., where she is expected to meet with Speaker Kevin McCarthy in Los Angeles. Now, you've mentioned that that threat has sort of been issued, this warning that McCarthy should not take the meeting. But from what I have heard from Kevin McCarthy when it comes to Taiwan, is that he is every bit as eager to be just as aggressive as his predecessor Nancy Pelosi was. I mean, certain concerns did not stop her from going to Taiwan. And at this point, it seems like McCarthy is just as eager to be just as aggressive, just as hawkish, and to have this meeting with Taiwan's president. Of course, we'll see what the next developments are here. But it's certainly something that McCarthy is eager to do, is to kind of put on that very aggressive, hawkish stance.
Emily, just quickly, consequences. This is what China had to say. The Chinese government, we will definitely take measures to respond. Do we know what they are?
We don't know at this point what they would be. I mean, certainly we can look to what happened after Pelosi had her trip to Taiwan with some of the increased military action in the area. But I think to a certain extent, this is all going to have to be a balance game. That Biden administration, they want to have that working relationship with Beijing. They want to keep the lines of communication open. But at the same point, being aggressive against the Chinese government, it's one of the few areas of bipartisanship and one that lawmakers are looking to.
Emily, thanks for that. Let's get back to the market. 23 minutes in, equities up by 1%. Katie has some sector price action. Hey, Katie.
Hey, John, all 11 sectors in the green right now. Real estate leading the way. Healthcare, your relative underperformer, still up about 0.4%. I want to talk about chips, though, because you have the SOX index outperforming today, up 2%. Look at the year-to-date board, up 23% this year,
wow.
24%. Not bad.
What a move, Katie. Thanks for that. Up next, your trading diary from New York. This is Bloomberg. As always in this situation, there's one question. Will it stick? Decent day of gains on the cards right now. 25 minutes in, up by about 1% on the S&P, on the Nasdaq, up by 1.4%. That's the price action. Let's get to the trading diary. Bank hearings continue on Capitol Hill, top of the hour. Then we get economic data from pending home sales on Thursday. US GDP, another round of jobless claims, plus more Fed speak. Kashkari, Barkin, Collins on deck, followed by Williams, Waller and Cook on Friday. And we close out the week with a UMich sentiment survey. I just wonder how important the incoming economic data is now, given the banking difficulties of the last couple of weeks. And I've mentioned this a few times, data dependent on what data? Is it a banking situation or CPI and payrolls, retail sales and all of the above? We'll continue that tomorrow. From New York City, this was the Countdown to the Open. This is Bloomberg TV.